Bitcoin's history looks like pure chaos on the surface. Prices skyrocketing, crashing, and exploding in unpredictable directions. But watch what happens when you hit reverse. We usually assume these massive financial surges are driven by internet hype, a sudden panic, a billionaire's social media post, or market manipulation. This chart begins with a jagged, volatile price history, but watch as it straightens and resolves into a rigid, repeating step function. Those wild swings follow the deliberate output of a hard-coded mathematical rule. This unchangeable rule, sitting at the base of the software architecture, is called the halving. To understand why the asset actually behaves this way, you have to ignore the day-to-day market noise and look directly at this mechanical design. Every 10 minutes, the Bitcoin network produces a steady stream of newly created currency. This acts as a reward to pay the operators, the miners, who secure the system. But written directly into the code is a trigger mechanism. After a specific number of data blocks are processed, the software forces this daily production rate to drop. This flow system represents incoming supply. At the trigger block, a mechanical gate drops, reducing outgoing volume by 50%. Zooming out, new coins entering the global market daily takes an immediate forced plunge. Heavy, predictable supply instantly reduces to a restricted trickle. This drop is not phased in slowly. It hits the entire ecosystem at once, creating an immediate supply shock. The halving operates as an engineered, unavoidable restriction on the asset's availability. We know what happens to the supply. Now we have to look across the aisle at the demand side of the market. Historically, user adoption and market demand for the asset either hold steady at their baseline or continue to grow as more capital enters the network. While the demand curve remains anchored, the newly throttled supply curve violently shifts left. An immediate market deficit opens up. Total capital drastically outnumbers available units. As buyers compete for this restricted pool, a bidding war forces severe upward pressure on the equilibrium price. Once that initial upward climb begins, it trips a psychological wire in the market. Watching the asset gain value brings in waves of new buyers. Their new capital hits the ecosystem, accelerating the initial mechanical pressure and compounding the upward momentum. This momentum leads to the massive price surges that capture the general public's attention. All these explosive price cycles result from the direct collision of market demand against a hard-coded supply wall. When the dust settles, the core truth remains. The halving creates digital scarcity in the modern financial world. This mechanism operates on a strict mathematical limit. It behaves differently than traditional fiat currencies, where central banks can print new supply on demand. Recognizing this mechanical predictability separates informed, long-term market observers from the purely speculative crowd. Bitcoin's most dramatic market explosions are the quiet execution of its foundational code.